My name isn't important, but a few years ago, I was what people call financially responsible. I had a stable job, money in savings, a retirement account, insurance, even some equity in my home. And then one random Tuesday, my car broke down. The mechanic said it would cost about $400 to fix. I didn't have it. Not without penalties, not without selling something, not without calling someone and feeling embarrassed. That was the moment I realized something terrifying. I wasn't broke, but my money was. So today, I want to talk about a trap nobody warns you about, the moment your money is safe, but you are not. My name is John, and I'm not a financial guru. I'm not retired at 35. I don't own rental properties in 5 different states. I'm just a regular working person who got tired of feeling anxious about money despite doing everything right. This channel exists for people like us. People who pay their bills. People who save consistently. People who don't gamble their paycheck on crypto or lottery tickets, and yet still feel one emergency away from panic. Today's video is about something I wish someone had explained to me earlier. It's called the Personal Liquidity Trap. That sounds technical, but it's actually very simple. A liquidity trap is what happens when your money technically belongs to you, but you can't use it when life actually happens. It's money locked in places that look safe and responsible on paper. Long-term savings accounts, retirement plans, insurance products, home equity, but become painful, slow, or expensive to access the moment you truly need them. And here's the uncomfortable truth. Most financially disciplined people are more vulnerable to this trap, not less, because the system rewards behaviors that lock money away. Banks love deposits they can count on for decades. Insurance companies love monthly payments you forget about. Housing markets love buyers who stretch themselves thin. Society praises this as maturity. But life doesn't care about maturity. Life cares about timing. A broken car doesn't wait until you're 65. A medical bill doesn't care that your net worth is high on paper. Stress doesn't ask whether your money is earning interest. In this video, I want to walk through 3 things. First, where money usually gets frozen and why it happens so quietly. Second, the math and psychology that make this feel safe even when it isn't. And finally, a simple framework that helped me stop feeling trapped by my own savings. This isn't financial advice. It's not about chasing returns. It's about something more basic, having options when life doesn't give you time to think. Let's start with the most uncomfortable realization. Most of the money that gets people into trouble is money they were told was safe. Take a typical working adult. They don't keep much cash around because that feels irresponsible. So they move it into a savings account, then into a fixed deposit, then into retirement accounts they can't touch until decades later. On paper, this looks perfect. In reality, it creates a very specific kind of fragility because safety and accessibility are not the same thing. A savings account with withdrawal limits, penalties, or delays isn't really liquid when an emergency happens on a Friday night. A retirement account that punishes you for early access isn't protecting you, it's disciplining you. Insurance products are even more subtle. They don't just lock your money, they lock your thinking. Every month, the payment goes out automatically. It feels responsible, it feels adult. But if you actually need cash, you're told to borrow, surrender the policy, or wait. The money exists, it's just not on your side. Then there's housing. This is where the trap tightens. You buy as much house as the bank will allow, not because you're reckless, but because everyone says real estate is the safest asset. So your paycheck goes into a mortgage, your emergency fund shrinks, your flexibility disappears. You become what economists politely call house rich and cash poor, which is a nice way of saying you own something valuable, but you can't eat it, drive it, or use it when things break. And things always break. A job loss, a sick parent, a car repair, a legal issue. This is where the liquidity trap reveals itself. Not in theory, in panic. People with high net worth asking friends for short-term loans. People paying high-interest credit cards despite having 6 figures locked elsewhere. And here's the cruel irony. The more disciplined you are, the more likely you are to fall into this trap because you trusted a system that values predictable money, not available money. Here's the part that rarely makes it into personal finance advice. Not because it's complicated, but because it's uncomfortable. We're taught to ask one question about money. How much does it earn? But almost nobody asks the second, more important one. What does it cost me to not have access to it? Let's make this painfully simple. Imagine 2 people. They earn the same income, they save the same amount every month. Person A keeps a meaningful portion of their savings liquid. Person B locks almost everything into long-term accounts, insurance, and property. On paper, person B looks smarter, higher net worth, higher discipline, better looking spreadsheets. Now fast forward 10 years. Nothing dramatic happens, just normal life. A few car repairs, some medical bills, a short period of unemployment, a family emergency. Person B doesn't sell assets. They don't break long-term plans. They do what most people do instead. They swipe a credit card. They take a short-term loan. They pay overdraft fees. They pay interest. Slowly, quietly. Let's talk numbers. If you carry just $3,000 on a credit card at 20 interest and it takes you 2 years to fully pay it off, you didn't just spend $3,000. You spent closer to $3,700. Now repeat that pattern a few times over a decade. That's not bad behavior. That's bad liquidity. And it gets worse. Because when your money is locked away, you don't just lose money, you lose options. You can't say no to a bad job because you need predictable cash flow. You can't take a lower paying role with better long-term upside because your bills are rigid. You can't absorb shocks calmly because every surprise feels like a threat. This is the cost nobody puts in the calculator, the cost of forced decisions. And then there's inflation. A savings product earning 3 in a world where living costs rise 45 is not preserving value. It's slowly shrinking your purchasing power while convincing you that you're being responsible. So when people say, at least my money is safe, I always want to ask, safe from what? And safe for whom? Because money that grows slowly but traps you into expensive behavior can cost far more than it earns. Here's the hardest part to admit. Most people don't fall into the liquidity trap because they're bad at math. They fall into it because the trap feels like virtue. We're wired to fear loss more than we desire flexibility. Psychologists call this loss aversion. The pain of losing 100 feels stronger than the joy of gaining 100. So locking money away feels comforting. If I can't touch it, I can't mess it up. If it's locked, it's protected from me. And the world reinforces this belief constantly. We praise people who never touch their savings. We admire those who leave retirement alone no matter what. We call it discipline. But discipline without context can turn into self-harm. Another force at play is status quo bias. Once your money is set up in a certain structure, automatic transfers, locked accounts, fixed commitments, changing it feels risky, even if staying put is hurting you. So you endure. You tolerate stress. You tolerate bad credit card debt. You tolerate anxiety. Because changing the system feels scarier than suffering inside it. And then there's social pressure. Locked money signals responsibility. Owning a home signals adulthood. Long-term insurance signals foresight. Retirement accounts signal maturity. Liquidity signals nothing. No one congratulates you for having options. No one praises flexibility at a dinner party. In fact, flexible money is often framed as laziness. Why isn't that invested? Why are you holding cash? Why aren't you maximizing returns? So people lock money away not because it's optimal, but because it earns moral approval. And this is where the trap closes. You feel proud when you commit. You feel ashamed when you need access, even when needing access is exactly what money is supposed to provide. So instead of asking, does this structure serve my life? We ask, does this make me look responsible? And slowly, without realizing it, we trade resilience for appearances. To be fair, this advice didn't come out of nowhere. For our parents and especially our grandparents, locking money away actually made sense. They lived in a world of stable careers, one employer for decades, predictable pensions, affordable housing relative to income. Liquidity wasn't as critical because life shocks were smaller and systems were more forgiving. If you lost a job, you often found another similar one. If you needed help, families lived closer together. So saving hard and touching money as little as possible wasn't a trap, it was survival. But the world changed. Jobs became temporary. Healthcare became expensive. Housing stopped being a utility and became an investment. Wages stopped keeping up with costs. Yet the advice stayed the same. Lock it away. Don't touch it. Think long term. And that mismatch is where modern anxiety comes from. We're using old rules in a faster, harsher system. There's also a cultural layer. In many cultures, especially immigrant and working class ones, cash flexibility is seen as instability. Owning things, homes, policies, accounts, signals that you've made it. So people stretch themselves thin to look secure. They trade adaptability for permanence. But permanence only works when the ground underneath you doesn't move. Today, it moves constantly. And when it does, rigidity breaks. That doesn't mean our parents were wrong. It means their map doesn't fit today's terrain. And following the wrong map doesn't make you foolish, it just makes you lost. This is the part where most finance videos tell you to do something extreme. Sell everything, invest aggressively, never hold cash. Or the opposite, ever take risk. That's not what this is. Escaping the liquidity trap isn't about being bold, it's about being deliberate. The first shift is to stop thinking of money as one pile. Instead, think in layers. Layer 1, survival money. This is boring money. It doesn't exist to grow, it exists to absorb impact. Rent, food, transportation, one unexpected bill. For most people, this isn't 6 months of expenses. It's often 500 to 2,000. Small, liquid, and emotionally calming. This layer alone can prevent overdraft fees, credit card debt, and panic decisions. Layer 2, stability money. This is money that supports your life rhythm. It might be in a savings account, a flexible investment account, or anything you can access without punishment. It gives you the power to say no. No to a toxic job. No to overtime that's costing your health. No to rushing into bad financial choices. This layer doesn't need to be massive, it needs to be reachable. Layer 3, long-term money. This is where retirement accounts, insurance products, and long-term investments belong, but only after the first 2 layers exist. Long-term money should never be your first line of defense. It's a backup plan for a future version of you, not a substitute for stability today. The second shift is asking a new question before committing money. Does this give me options or take them away? A home can be an option. It can also be a cage. An investment can be growth. It can also be rigidity. The third shift is emotional. Let go of the idea that needing access means failure. Money isn't a test of character, it's a tool. Using a tool when it's needed isn't weakness, it's competence. And finally, start valuing time and calm as returns. If having 1,000 liquid saves you months of stress, that's a return. If flexibility lets you leave a bad job sooner, that's a return. If peace of mind helps you sleep, that's a return no spreadsheet shows. If there's one idea I want you to take from this video, it's this. Being good with money is not the same as being safe in life. You can have impressive accounts, solid assets, and a responsible looking plan, and still be one bad week away from panic. That doesn't mean you failed. It means the system taught you to optimize for the wrong thing. Money is supposed to give you options, time to think, room to breathe, the ability to handle surprises without fear. When money is locked away too early, it stops doing its job. So instead of asking, how much can this earn over 30 years? Try asking, what does this allow me to do next month? Build liquidity before you build legacy. Flexibility before optimization. Calm before returns. If this video helped you see your own situation more clearly, share it with someone who feels anxious about money even though they're doing everything right. And if you want more conversations like this about money, systems, and real life, consider subscribing. My goal isn't to make you rich on paper. It's to help you be wealthy in life.